a very special guest, Adrian Mowat, Chief EM and Asian Equity Strategist at JP Morgan, to speak about how has he read into the move and the implications thereof, more importantly. Adrian, good morning and thank you so much for taking the time out. Afraid it's not turning out to be a very good morning. It almost seems like the rest of the world was hoping for a rate hike to happen and the uncertainty being left out. That hasn't happened and the markets have reacted slightly mixed. What do you think are the repercussions or the implications of the move and the testimony?
Well, I mean, you're spot on. The feedback very clearly from our clients is that they would like to get the Fed behind them. They would like to have the sort of confirmation that the world will survive with an interest rate hike, which clearly it will. And by this delay, by this new level of uncertainty in terms of they seem to have moved the goalposts, I don't think that is very helpful for capital markets. You know, capital markets, when they're uncertain, tend to have higher PEs, have risk premiums, you know, credit spreads rise. So we're disappointed by the lack of the move. And we're a little bit unsure about how to predict what the Fed is going to do. You know, why would they move in October? How's the data going to improve? Is she going to look at the Chinese economy? That would be rather unusual for the Fed to be doing, but she did mention the Chinese economy. I don't like the idea of a feedback loop between markets and central banks. You know, markets want someone to take a lead and then they can price off that. I think if markets go up and then the market fears that that'll allow the Fed to raise rates, you know, it gives you a rather unpleasant oscillation in a trading range.
Adrian, hi, good morning. You know, I was just going to come to that. Janet Yellen categorically mentioning that the recent global turmoil may restrain economic activity, clearly hinting towards China. Do you think at a point like this, when you know the Fed is in no mood to move, the bigger uncertainty is the PBOC?
Yeah, I think the uncertainty around China, both the economy and the central bank's intentions with both local interest rates and with the currency, probably now become front and center in terms of capital market focus. What I think has been weird about the sort of whole story around the Chinese economy is the Chinese economy has been very weak for a protracted period of time. You know, year to date, imports are down 14%, you know, which is a pretty damning indictment of China's sort of demand for global products. That didn't occur just because the stock market fell. I think in the stock market declining, and remember, it's still one of the best performing stock markets over a 12-month period, but the way it corrected, it then got people to look for that cognitive resonance. Give me the bad data point that explains why the equity market's going down. And they looked at the macro data. And so China has been a function of people's uncertainty in terms of the economy. Then on the 11th of August, the central bank threw an enormous stone in the pond with talking about moving the currency regime, and the currency went down. But the interesting thing about the Chinese renminbi is it's devalued by only 3%. People are sort of behaving like it's a lot more, but maybe it's a bit of a sort of sword of Damocles that is hanging above you, and people feel that it's going to move more. I think, though, that probably what happens with the renminbi is very little. The currency would seem to be very well supported, judging by a current account surplus, even though real effective exchange rate may have appreciated. And we could get a situation that confidence gradually recovers. I think the other thing we're going to see in the Chinese economy is that the rate of change is improving. We've got very good data points from the residential property market, which is up about 20% in the last couple of months in terms of volumes. We're seeing some stabilization in the auto market. Consumption looks okay. Government spending, which had been weak all year, picked up noticeably last month. So my suspicion here is actually that China, instead of being very damaging for markets, starts to become more constructive in that the economic data begins to improve versus a very bearish sentiment.
Adrian, so one, it is true that the Chinese data has probably been not so bad. I mean, the auto sales numbers and a few other indicators have been okay. But if you look at the Chinese exports data, that has not been that great. Indian exports data are not comparable to China really, but has fallen off a bit. And the Fed also indicating that growth is not as per the mark for them to raise rates. Does it put a cloud over global growth, and therefore, is it proper to be slightly bearish or skeptical on equities at large for the next 3 to 6 months, at least?
Okay, so I mean, it's sort of interesting you're questioning in, there's definitely a perception out there about the global growth dynamics, but if you look at the US, the UK, and the European economies, they're all running above potential GDP. So they are quite strong. And Japan is running at potential GDP. So we have a dynamic that actually the global growth numbers are okay. Where there is weakness is in the emerging world. So we have the extremes of Brazil and Russia in recession. At the other extreme, you've got CE3, so Poland, Hungary, the Czech Republic growing much above trend. We've got an ongoing decline in the growth rate in the Chinese economy, and obviously there's a confusion around, whether you agree with the GDP numbers. And then we've had some interesting dynamics, very strong consumption numbers out of Korea, particularly if you look at the housing market. Taiwan actually looking quite good domestically. I think India and Indonesia are being held back because central banks there have policy rates above 7%. And looking forward, inflation's coming off quite a lot, so the real rates are too high. So I think there's a bit more of a nuance to this growth story. Now, one thing's for sure is we don't seem to have the normal beta of global trade to GDP that you used to get. But I do think we're in a different dynamic globally where you have more local production. In the US, if the US economy is doing well, it probably benefits Mexico and Canada rather than necessarily the global trade dynamics. And one of the reasons that Europe is doing well is that the currency has weakened, so the purchasing power of Europe has gone down, and hence exports from Asia are down. The other thing to bear in mind here when looking at this data is it's nominal data. We've had very large declines in commodity prices. And in that the price of steel has come down, then products that are made out of steel, the price of those come down. I think that's all having an influence in the headline nominal trade data.
Adrian, at a time like, when world economies, like you just highlighted, are working with different dynamics and clusters, if I may add so, of their own, and it seems like world equities, on the other hand, are trying to align themselves across the globe right now. What is the sense? I think we've lost the line with Adrian, have we? No, we're back with him. Yeah, so Adrian, my point being, world economies are moving with dynamics of their own, and equities, on the other hand, seem to be aligning themselves across the globe. How do you think money is going to flow in? Do you think money is going to move out of EMs and continue to pour into developed markets? Or do you think some of it may actually find its way back into EMs as well?
Well, we're running out of money in EMs. There's been so much selling going on. We're looking at the outflow from retail EM products almost at the same level of 2008, and assets under management were much larger in 2008. And we're seeing the selling both in equity products as well as in fixed income products. So I think the flow story is something we're experiencing, and if anything, again, the second differential is improving. I'm not a great believer in spending much time talking about flows and thinking about flows. You're better off to think about how will fundamentals change, and how will that then influence the marginal buyer. So I think you've probably had an overshoot in EM currencies. We were hoping that a clearer message from the Fed would cause more dramatic short covering. To some extent, we did see that in the Mexican peso overnight, but would have liked to have seen a bit more. And I think if Indonesia move into a rate cutting cycle, that will attract capital. Because I don't view these as carry markets, I view them more as growth markets. When the investors start to pay attention to what's going on in the domestic economy in Korea and Taiwan, I think they'll be buying those markets, and pay attention to what seems to be a turn in the semiconductor cycle. Which I think is underappreciated, and technology is a very big part of the EM benchmark. Tech hardware is much bigger than Russia and Brazil combined. So I can see some drivers fundamentally that could cause an adjustment in a very bearish view on EM.
Adrian, so what about India? I mean, if I remember our previous interactions, you've been largely bullish on India. You're right now sounding maybe slightly skeptical about the EM trade at large. Would India defy that, or do you think we move in line with how EMs will generally move over the next 3 to 6 months?
Look, I described a more constructive view on China than the expectations, which is why I think emerging markets will be recovering. I've also described a much more benign, if anything, attractive economic environment in Korea and Taiwan, plus a recovery in the tech sector. So if you start adding China, Taiwan, and Korea together, you've got more than half the benchmark. I think those markets can give you good returns into the year end. I would expect India maybe to lag a little bit in an EM recovery rally, just because it has outperformed and positioning is more bullish. Now, when we look at the drivers of the Indian story, I think we've processed the disappointment around GST and expectations have been managed down. We've clearly got anxieties around rural demand with the poor monsoon. But we also need to remember that we have a central bank that's running very high interest rates relative to inflation. And India and Indonesia offer us at some point the potential of starting an easing cycle. I think at the margin, the Fed confusion overnight probably doesn't help the RBI. I think they'd probably be more comfortable to move after the Fed had moved. But we've still got that in front of us. And I think you'll get more fiscal traction as well. So India looks like a country where the fundamentals will be improving into 2016. So I think as a trading call, if you see a recovery rally, India fell less, so probably rallies less. But as a medium-term story, it still remains one of the best in emerging markets.
Okay, Adrian, just before we wrap up then, we've taken a lot of your time. What do you think is in store for India aside of all that's happening globally? Because a lot being spoken about reforms or the lack of them and earnings, and they might come delayed, much more delayed than what was hoped earlier. Core India story, what are your thoughts?
Yeah, so, I talked about the rural story, which has been weak, and there was hope for a recovery in that. I think we shouldn't be too pessimistic around the earnings story. The Indian economy is building momentum. Some of the macro data we look at looks encouraging. So, I think going into 2016, the earnings story in India will be supportive, particularly on a relative basis in what's still a pretty tough world.
Such a pleasure speaking with you, and thank you so much for taking the time out and speaking with us today.
Pleasure. Thank you.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.